This week's been a good week. I mean, we got some exciting news. Galileo's back in the picture. Earnings are coming up. Things are starting to sort of heat up. NBA is starting to kick off. We're seeing the SoFi play-in tournament evolve, and there's been a lot of traction around this tournament. SoFi is plastered all over with the NBA posting advertisements onto their Twitter accounts saying, sign up for SoFi. You can enter a chance to win their SoFi Zeros giveaway or whatever it's called exactly, and get a chance to win a $10,000. We'll be doing giveaways every single week. Tevis very prominently pointed out this may be working quite effectively.
Okay, these numbers fluctuate pretty wildly. I think Apple resets them like on a weekly basis. If you look right now, I actually have it open on my other tab. We're 30 right now.
They've really been leveraging, I think, these partnerships, especially the NBA, very well. A lot of minor partnerships too. We're seeing a lot more website traffic this quarter. That's the highest 3 months are all in this year. So it's just, and of course, we see the app rankings as well. I think it's going to lead to membership growth. When they announce the NBA, are they going to see a fantastic beat in what they've guided for? I think so. But like, how much of one? Are we talking like Taylor Swift quarter level of beat? Maybe not, but no, if we're like at football level of beat, and it's like I'm seeing clips not related to SoFi at all, from SoFi people rather, just NBA stuff with SoFi in it. I'm like, that is good. That is cool.
Just the volume, how much the NBA has been promoting this is fantastic to see. All of their social media handles, they have the hashtag in their account description. They're doing play-by-plays of all of the games with the SoFi hashtag. And it's just from an impressions perspective, it's absolutely insane to see how much the NBA is pushing it. I mean, look, I am accounting for the NBA deal to affect members in Q1, but the NBA deal was signed on February 14th. So like halfway through the quarter, and it didn't ramp up until like the beginning of this week with the play-in tournament. There were games, there was advertisement, there was the All-Star weekend, but there was nothing sort of major. I think the bulk of that is going to reflect in Q2. For the last 3 weeks, the quarter has been closed, and as a result, those members don't like they count into the next quarter.
I realize it's not full quarter thing, but there is some impetus there. It's not that we're going to see absolutely nothing for the NBA deal. Plus, they have other smaller partnerships. Something's been generating clicks, and
I didn't factor it into my Q1 numbers, but it was announced in Q1, right? There was an initial push in Q1. It's just really the main games and stuff like this is in Q2, the sort of SoFi play-in tournament, which is seeing more traction to their name than the usual part. But did you guys see this Forbes article talking about the top banks in the United States?
mm-hmm.
I have the full list here. Number 1, USAA. Number 2, Capital One, Gate City Bank, all the way down till number 5, SoFi Technologies. You're going to have to keep scrolling for a while before you see Robinhood or anything like that because it's not a bank.
You're going to have to keep scrolling until you see any of the big four banks. JP Morgan's not on there.
Well,
Wells
it's based on
Fargo.
customer satisfaction. That's why.
Exactly. They have a paragraph where they describe the methodology by which they gathered these results. If I remember correctly, they surveyed about 49,000 people across 33 different countries. They asked them basically to rank their satisfaction across 5 different vectors of banks that they're either a part of, that they've been a part of over the past 3 years. It makes sense for SoFi to be higher up in the US list because they wouldn't even be aware of SoFi outside of the US. And it's purely based on satisfaction. So you're going to find a massive discrepancy here between SoFi's ranking and the actual list of banks by deposits.
Sure.
Large banks have a less well thought out product from user experience perspective relative to SoFi.
Rapid Finance taps SoFi and Galileo to enable small business financing. Rapid Finance, a small business banking platform helping small businesses find customized financial solutions, in collaboration with Galileo Financial Technologies, today announced the launch of Rapid Access MasterCard. The Rapid Finance MasterCard program is the first program sponsored by SoFi Bank and managed by Galileo. Rapid Finance's SMB customers with a line of credit in good standing can seamlessly and instantly access their funds to maintain their operations through the card. Okay, so as you're spending, it's actually coming out of your line of credit. This is a card issuing partnership on SoFi Bank, the first of its kind.
The thing that made me excited about this is exactly what you mentioned. Like, this is a collaboration between the banking side of the business and the technology side of the business. And here we see a playbook that we can extrapolate forward for future partnerships. Rapid is a sister company of Rocket Mortgage. And so I was mentioning in a video that I did earlier today that I like speculation. I think it can open the door for future partnerships of a much larger size in that space. I definitely think the headline was that collaboration between the banking side and the Galileo side, because the type of partnership before, I mean, them offering that card, having access to SME funds, they've done that type of partnership before. Galileo has done a couple of those now. And so the only unique factor here was the fact that it's leveraging SoFi Bank as well.
It does show that AWS of FinTech is rolling out. It's very exciting. This next quarter, I'm saying about 610,000 new users. What did you guys say for members, or what are you thinking around members for SoFi's quarter?
I put 635. The reason for 635, I put a little boost on the MBA side of the business. That partnership halfway through the quarter, all of the other benefits around referral bonuses and the credit card benefits and Wyndham Clark, like all of that stuff falls in Q2, and as well as the play-in tournament. My number is going to be much higher for Q2, most likely, just because of these initiatives ramping up. But because it hit halfway through the quarter, you have to understand that there's usually a dip in Q1 relative to Q4. And so I was just looking at that trend, and the only number that was outside of that trend was Q3 of 2023, which was 717, I think. Q4 it dipped again to 583, and so this quarter normally you would expect lower than 583, but I still think we're going to have that compounding through that flywheel. And then I also added a tiny little premium to the MBA side as well from an awareness perspective. But
I'm a little bit more bullish on it. I realize that these partnerships that they've leveraged don't all fully hit in quarter one. We'll really see that, I think, ramp in quarter two. But based on the website traffic, based on the app's popularity, based on some of the partnerships, and then the higher for longer. That's the other thing, is there's people that probably thought, oh, federal government's going to be cutting anyway, so yeah, I could switch over to SoFi, but it's not going to. But they've been saying that for a while, and I'm one of those days. I'm like, I just need to switch over. So myself and other people have been doing that, even though it's an aberration for a quarter one. I'll admit that fully. And if it falls under this, that's fine. But I think that we're going to see around 650,000 new members, 44% year over year growth. It's optimistic, but I mean, they've continued to beat my expectations here time and time again. And this time, I'm not underestimating them.
There's nothing really surprising if we jump into products. I have noticed that the 1.5 ratio has been a little bit softer in recent quarters. It's been falling. I basically just multiplied my number by 1.5 and then reduced some off the top. So I came at 935,000 new product additions.
If we don't see 650 quarter one, fine. 500,000, 550, that's okay. With the partnerships that they have in play, and this NBA one, like it's doing really good things. There are some seasonal effects as far as SoFi Stadium, concerts, football, certainly. It seems like there's some seasonal as far as when people are willing to change over from banks. Everything just seems like it's lining up well, and they're leveraging things well. So yeah, we'll see.
Products per member. This has been going down. So they say that they're sort of guiding for that 1.5 times. Say for every 2 members, there's 3 products outstanding. 1 checking account, 1 relay account, 1 personal loan, something along these lines. In the last couple of quarters, this hasn't been large fluctuations because we're in the tens of millions now for products. There'll be slow fluctuations as we return back to a median or change out of it. But we've been at 1.513 products per member, then 1.507. 1.502. Then in the most recent quarter, real big drop off, 1.477. Where do you guys see this going? Do you see that reverting back up?
When people join SoFi, it's typically one product at a time, and it takes time for that flywheel effect to really have full effect. If people are jumping on because of relay, they'll be more open to a bank account in the future. Maybe they'll sign up for checking, and they'll be like, oh yeah, savings is a good idea, or invest. But it doesn't, typically you're not on and you're like, I'm going to sign up for 5 products right now. I've joined, as an example, Relay officially, and I'll be opening up a bank account here within the next month. And we had a massive glut of people join in quarter 3 and also quarter 4 relative to the size of the company. So it'll take time for those to be digested.
I think it'll stay stable for some time. If you look at the aggregate numbers of where we're getting most of our members, it's all in financial services. And then you look at the benefits that SoFi is now providing. I could totally see people switching their direct deposit to cash in on that benefit, getting the referral bonus, now with the credit card benefits being where they are, getting that as well. And so the more that they incentivize financial services, I think the better it's going to be for that cross-pollination of different products, because financial services has the lowest barrier to entry for a flywheel effect. Lending, I don't see people rushing to get a personal loan with interest rates so high. Financial services is just going to be the easy, low hanging fruit from a cross pollination of products per member perspective.
Lending products, in my opinion, may start to slow throughout 2024. When that happens, there's going to be a much larger representation of financial services products. Exactly what Tevis said. There's a much easier way for the people who come in for a checking account to get Relay, to get a credit card. If you had met SoFi with the idea that they were going to potentially, you found them on NerdWallet or Credit Karma or something like this as just being the cheapest personal loan for you possible based on your credit card and FICO score, you may have had no intention of cross selling at all. You're there to pay off your loan and then you'll be gone. That was a lot of their members for student loans.
Noto usually guides very conservatively. When he puts timetables on something, just think for a second if he's actually being conservative, what that could mean for the company. By the way, before we end today, we need to look at analyst expectations.
0.0058. This is not the amount of Bitcoin you're holding. This is actually the analyst estimates for Q1, and then Q2, it's still 0.0119. So basically, analysts are saying this company is going to come absolutely flat. They're going to be positive, but it's going to be absolutely flat for this upcoming quarter. And even Q2 is going to be 1 cent EPS. Just look at this trend. I'm not surprised why people are adding 2 cents or 3 cents or 4 cents on top, because every single quarter, 2 cent variance, 4 cent variance, 3 cent, 1 cent, 5 cents, 2 cents. What every retail investor is looking at is saying, okay, 2 cents or 3 cents, just going off of the trend.
Some people's guides are higher for net income. What I'm hearing in the chat is like higher than what they're saying is going to happen in EBITDA. Are they not still going to have stock-based compensation? Are they not pouring a ton of money into sales and marketing?
I think one of the key differences, Tanner, is that people see, a number and then they just gut impulse say, whatever the net income number is. Whereas you deduce your net income number from going from the top line to the operating expenses to the SBC to, everything all the way down. And then you get like a scientific method of getting to the net income. People see, okay, they did 40, they're going to do 60. Without really realizing the contributing factors that make up that net income. I think stock-based compensation is going to be higher on an aggregate number, probably lower as a percentage, still keeping with that trend, but probably higher on an aggregate number, simply because they had Arun Pinto join as their chief risk officer. Aaron Webster left the company. They've had a number of executives joining. They had the new board of directors member, Dana Green. And they also had the director of engineering that Roy talked about. So they've had a couple of some pretty senior people. Those people have SBC costs as well. So SBC, I think, will be definitely higher. That's going to contribute to the bottom line as well.
The lending segment is the other one that I'm very, very interested and curious about, because SoFi guided for 90 to 95% over 2024. So slower growth, of course, with some very bearish macro assumptions. Some as far as the rate cuts are proving true, but the economy seems like it's more robust so far. We're higher for longer for sure. And they've alleviated some of the capital constraint concerns that some had, mostly bears. And so I'm just kind of curious, when that deal happened, the senior convertible notes, it wasn't like 3 days before they're like, hey, let's do this. And then they did it. They knew months in advance that, hey, this is probably where we're going to go. And based on those assumptions, as they're finalizing deals and preparing for that announcement, I'm very curious if they took that opportunity to say, okay, we can be a little bit more aggressive here this quarter one, given what we know and where we're headed as a business. And also if their members continue to grow and deposits keep going up.
Yeah. Are you talking purely for the revenue side?
Just lending as far as originations. And I also have a net revenue prediction as well. So I'll do this.
Just anecdotally, I kind of have the opposite take. I think that they're going to be a little bit more conservative in Q1. And I think we've been seeing from the news that they've had, partnerships that just came to fruition in Q1 that they've been working on behind the scenes for a while. But really Q1, Wall Street is looking for that continuity of profitability to gain confidence going forward. They don't want to do anything to jeopardize that. Even something as small as the credit card benefits, the referral benefits, them jacking up some of the bonuses that people get. that's really when I think they're going to let loose with the member additions, try to maximize on that front. But Q1 is really that transitory period where they have to still be a little bit more fiscally conservative to make sure that they can have that follow through on the bottom line and do so in a way that beats Wall Street expectations so that Wall Street can guide upwards and so that they as a company can also guide upwards, especially when you consider some of the changes in the macro assumptions that they had built into their business. You have to keep in mind that SoFi had multiple, rate cuts. We're not going to get that situation. It's much more bearish than it was in January from a rate cut perspective. And so I think that so many things have happened over the last 3 months that I think, especially considering the SoFi management team naturally being more conservative, that they would have focused more on the profitability side of the pendulum as opposed to the members side. And as more quarters go by and they keep compounding on all three of their business segments being sustainably profitable and the margins increasing on Galileo, so on and so forth, that then they can actually let loose a little bit more with their S&M spend.
So this is my origination prediction. I think student loans will keep being soft this quarter and next quarter as well. We'll see acceleration on that in quarter three and a lot in quarter four.
Is that just a little over 4.5 billion there?
Personal loans, I do think that we'll actually see a little bit of acceleration there, and home as well. Home is partly, I think that they want to grow that product a bit. Home lending is very seasonal, and it's at a very attractive interest rate. I think right now, I highly doubt that rates are going to be raised. And I think that they probably saw that there's some opportunity between what they're able to do, capital constraints with the macro. So overall, I saw rather than them decreasing this, that they had room to grow about 2 to 2.5% from quarter four, which that doesn't sound particularly exciting. But when they were talking about 90 to 95% over the 2024 for lending, decent. It's no quarter three. Like they can't really do that. Tevis is right. They have to be a little bit conservative, and they tend to be. But that would put my estimations for net revenue was about 355 million for lending. That's one of the reasons why I put the 2.5 cents in for EPS. So
I think that you're pretty hot on personal loans, in my opinion. I don't think that it'll be an acceleration. If anything, it'll probably, this is just my opinion, stay flat or potentially decline. Nothing below 3 billion, but I think they're going to play it closer to the chest. Defaults are seemingly rising and quickly, but
not universally. Like you're seeing the defaults, at least from what I did not look at every major bank, but commercial real estate, they thankfully have no exposure to that. But I think that the main cause for conservatism was partly that in quarter four, but they really, really wanted to hit that EPS. And I think that as the other segments continue to grow and improve and bring that profitability, that they have a little bit more room to not be super aggressive like they were in quarter three, but certainly a little bit more than quarter four. So yes, default rates are there, but they've guided for that. They've built out provisions for that. So, but every single what I'm saying is every single segment of the lending is not universally at risk. There are some where you're certainly seeing those default rates accelerate. Some which SoFi is not exposed to at all, and some which it seems like they're trying to limit their exposure to the credit cards. But it's not universal, and it also depends on the bank. Some banks are a lot more successful than Bank of America. Do you have a gut feel? Like, are you thinking? Well, you said it that they're going to be conservative, so that's good enough.
I said they're going to be conservative, absolutely, from a revenue and bottom line perspective. I think that lending overall, and I mean, I've said this since the last earnings report when they put out the guidance, and they said lending is going to come in negative for the year, especially in a higher for longer environment. I don't think lending is going to be as soft as they think it is, or as they guided for. It's probably going to be up single digits, is my estimate.
it's the biggest question I have about SoFi right now.
Which is
Aside from maybe just new Galileo ads, that's really hard to predict.
Yeah.
But what's happening with their risk-based capital ratios is really weird to me. It's all over the map. Essentially, SoFi at the end of Q3 of 2023, they had about 14.5% risk-based capital ratio, or RBC. they're not allowed to go below 10.5% from a regulatory standpoint. You don't even really want to be anywhere near it just in case there'll be natural fluctuation. So you don't want to kind of be anywhere near it in case defaults start to rise, something like this. So let's say 12.5% is their absolute bottom. What they started clearing that up in Q4, tangible book value grew quite a lot. So they got up to 15.3%. Then the convertible note came in, that'll be 17.3%. So they're now way above. They've got this huge buffer because supposedly they sold a ton of loans, maybe around 1.1 billion is what I'm seeing based on their forward flow agreement of about 500 million, and then ABS deals that people said were around 650 million, if I have my sources correct.
There were three pieces of news in quarter around loan sales. There's the forward flow agreement, and then there were two ABS deals.
It might even be more than 1.1 billion, but I think that's the amount that people have said that like we have, receipts. So lots of selling. What are the marks on those sales? I don't know. That could impact the stock, and greatly, by the way. That's what the analysts are looking for. We're looking for members and products. They're looking for what are the fair value marks on the loans. They said by the end of the year, they want to get back to 14%, yet they're selling a ton of loans. Repayment makes up for a large percentage. I think 1/6 of the outstanding principal gets paid every single quarter. It's an outstanding amount. That's like another, what is it? Almost $3 billion, or no, $2 billion, something like this. It's very hard to try to project what's going to happen for originations. We have to be paying attention to the fair value of the loans, the marks that they sold those loans at. That'll be important to Wall Street. The risk-based capital ratios. It's really what sucks about SoFi, or I mean, sucks for the stock. It's actually great for you and I if we can potentially see it and Wall Street doesn't. Is they're not simply paying attention to Galileo or financial services at all. And these sectors are growing even as a percentage of total revenue and as a total percentage of their overall profit, right? Their margins are very healthy as well. Wall Street is not going to be paying attention at all. I don't care how good it is at all to those sectors, but it's important for us to pay attention to it because that could change the thesis. But it's all on lending. That's where Wall Street's going to be because that's where macro is. So Noto and Crystal Point need to be very clear, very concise about every word that they say because Wall Street picks them apart, especially because the 10Q is not released right after. And so there leaves uncertainty about some of those marks before they release it the 2 weeks after.
There's going to be segments, and I think this will always be true with SoFi, just because they are very diversified, that there's going to be segments where bears will see bearish things, and there may even be some bearish things in the earnings report. I think that'll make it so that the reaction be beyond just the macro, that the reaction is maybe not what we are typically expecting with the SoFi earnings.
There usually is some bearish things every quarter, especially guys, whenever we set our expectations so freaking high. Last quarter, I remember a lot of people being quite disappointed with the member ads, and they added 584,000. But because we hit that 700,000 range, everyone was saying 700. There were large creators saying 800,000 plus. Anthony Noto and team can only dull your feelings for so long by saying, hey guys, maybe we should chill.
Yeah, I was
But
wrong on nearly everything else last time, but the student loans piece and the members, although it came in a little bit lower than I even expected, I actually kind of got those ones, but the rest I was terrible. So don't listen to me. I don't know what I'm talking about. These guys do. But, really, when it comes down to it, anything can happen. But this is a company that executes and executes well. I'm very confident in the long-term direction, even if there's some disappointment.
Galileo clients, any expectations? I said 6 million, and I got to be real with you guys. I think that's pretty shy. I definitely could see 7 to 8 million, but I'll keep it at 6 million because part of my quarterly expectations are also I look at it from Q1 to Q4 and how does that fit in with my annual guidance? Part of the 6 million is because I do think that there'll be acceleration throughout the year, and then I have higher expectations for the quarters to come.
Is it just a gut feel thing? What are you looking at to?
No new partner signups. We see a level of existing members signing up people through Chime, through Robinhood, through all these different platforms. So I'm banking it as just a regular level set growth of 6 million and nothing really past that. And it could even be lower than that if potentially we've lost a client or something like this. I just haven't heard any news.
I don't think logos is a telling signal of the volume for the accounts simply because because if we add up all of the logos that we possibly have confirmation on, I would venture to guess it's probably like less than 20% of Galileo's total client base. Majority of them are not public. It's like saying web traffic was really high. Yes, there's a portion of people that probably signed up on the web, but it's not a great indicator because there's too much left to chance. I'll take the opposite side for Galileo. And I don't have an exact number. Like I said, I haven't done my predictions yet. Thematically speaking, where I'm coming from is trying to work backwards from the first time they mentioned the POCs to, like, we're working with a large top 10, top five, whatever bank, and working to say, okay, what's 12 to 18 months of that timeline to try to deduce when these POCs could be complete, with the assumption that when complete, that accounts would start migrating over and we would see bigger chunks of accounts moving. If we do see a POC wrap up, we can definitely have double digit millions in additions, 13, 14, 15, 16. If we don't see a POC, and like you'll know immediately, like it'll be like a big addition. And then you can just say, oh, okay, well, if it were City or if it were, USB or whichever, you can very easily tell because of the volume of accounts. Otherwise, I think we could stay within that range, 7 million, 8 million. But I do think it's around that time, especially with the comments that LaPointe dropped about 3 months ago on the POCs being complete. The assumption there is that accounts will start moving over.
I'm just expecting slow and steady growth over, and they had, let's see, 145 million accounts on quarter four, an increase of about nine. So I don't know, somewhere between 5 and 10 increase.
Yeah, I mean,
No big
I'm
deal.
not expecting them to say, "Oh, we signed on with Citibank." Like that would break a whole bunch of rules that they probably have in place. But if they're at 145 and they come out this quarter and all of a sudden it's like 162, then you're like, "Okay, guys, let's read between the lines here. They obviously signed a huge account."
Who do you think that big account is? I think that it is Citi, in my opinion, just because they have history with Technisys back in the day, and there's not many top five banks in America to look at, and it's definitely not going to be J.P. Morgan or Bank of America, in my opinion. I think you're looking at Wells Fargo, Citi, and U.S. Bank. But that being said, there's an existing relationship with Technisys with Citi. If
But
if Citi comes over for Technisys, they would still call that a proof of concept, but yet it still wouldn't have a single account additive to Galileo's customer count. Citi could be a full-on onboarded client, and
already.
5 years later, zero customers will be counted as Galileo customers because they're Technisys back-end platform only. I'm saying that they're buying a different product.
Sure. Even if it's not reflected in the accounts, it would be reflected in the revenue, it would be reflected in the
Mhm.
margins.
I did $23 million of net income. That's roughly about a cent of EPS on a dilutive basis. On a basic EPS, it's like a little over 2 cents.
2.5 cents, so slightly higher. A lot more bullish, I think, on a couple of segments, and maybe not as much on others.
So net income, you're saying like what, 60 million?
Whatever that calculates to. We have more shares too, guys. So like as far as the actual net revenue, just keep that in mind if you're doing your calculations.
So I put my range as 1.5 to 2 cents EPS. I think that equates to about 30 to 40, 45 million in terms of net income. EBITDA margins, I was around 22 to 24 for the EBITDA margins. But 1.5, I think, is more realistic. I think they can definitely hit two. It's within the realm of possibility.
Stock price. Yeah, I mean, I think it'll be very different. Like if Roy gets his numbers, $9.50 end of day. If I get my numbers, I think $8, 7.80, $8.
A lot of it also depends on where we close. This is usually why we do the predictions next Friday, because it's the next market open that SoFi reports. The implied move is about 15%. Just looking at the options market and looking at previous earnings, implied move is 15 up or down. I wouldn't be surprised if it goes to 9. Maybe it sticks to that range and forms a new base. I mean, Palantir, don't forget, shot from 8 to 15 second quarter after profitability.
Sure.
That confirmation of profitability is a big signal for Wall Street. But again, we're operating in a very precarious market. From a macro perspective, there's uncertainty out there, right? Like you can go to sleep today and tomorrow you can wake up and find out that somebody's bombed somebody and we're opening red on Monday. And it's just, there's so many unknown factors, especially with a week left in trading. If it closes out, like let's say around 750 by the end of this week, then I think we can definitely hit 9 on a good earnings, a double beat and raise.
I really want to say 11 again, just because it'd be fun, but I don't really believe that. I think that we are reporting in a very different environment. And with some of the early earnings reactions, it's kind of interesting to track that where companies do perfectly fine. They've of course performed as far as stock prices, a little bit different than SoFi, and SoFi is a lot more heavily shorted. So there's going to be more volatility. I'm going to say 9, and I think 9 is being pretty optimistic, even given with what I expect as far as what they might deliver for earnings. If we see 11, they've done something incredible. I'm optimistically saying 9. I think there's a decent chance it's reasonable.
Thank you so much for watching and supporting the channels. But until next time, guys,
Peace.
bye. It's bye for now.